In the world of money matters, how stocks perform in Asia can tell us a lot about how people feel about the economy. Lately, things have been a bit mixed. People were hoping that interest rates might drop more, but those hopes are fading. On the other hand, China's stock market is slowly starting up again after a break, and it's doing okay. Welcome to Stock Whispers, your gateway to investment brilliance. Today, we will dive into why Asian stocks are not moving much right now, especially with people thinking less about interest rate cuts, and how China's cautious return to trading fits into the bigger picture of what's going on in the economy. Let's kick things off with a snapshot of what's been happening in the Asian markets lately. Picture this: while most Asian stocks have been treading cautiously within a tight range, China made a notable return to the trading floor after a week long holiday. Sounds intriguing, right? Well, let's dig deeper. The reason behind the cautious approach in Asian markets recently traces back to what's been happening on Wall Street. Basically, inflation data in the United States has shown a recent increase, making investors a bit nervous. Why the concern? Well, this uptick in inflation might lead to higher interest rates later on. Higher interest rates could affect borrowing and spending, which in turn could impact businesses and the overall economy. The situation boils down to this: when inflation goes up, it typically prompts central banks to raise interest rates to keep prices stable. However, higher interest rates can slow down economic growth and make borrowing more expensive for businesses and consumers. So, investors in Asian markets are closely watching the situation unfold in the US, knowing that any significant shifts there could have ripple effects across the globe, including in Asia. Why? Because such a move could send waves throughout the global market, affecting various aspects like how much it costs to borrow money and how much people spend. When there's uncertainty about what might happen, investors usually choose to be careful and not take big risks. The reason this matters so much is that changes in US interest rates can affect economies worldwide. If borrowing becomes more expensive, businesses might not expand as much, and consumers might tighten their budgets. This cautious approach by investors in Asia reflects their awareness of how interconnected the world's financial systems are and their desire to protect their investments from potential downturns. Despite the cautious mood prevailing in the markets, there's a ray of hope with China's market reopening following the Lunar New Year holiday. Many might expect excitement to sweep through, but the reality is a bit more tempered. Although Chinese markets did open on a positive note, the gains were not as significant as anticipated, staying rather subdued. The reopening of China's market after the holidays signifies a potential return to normalcy after the festive period. However, the modest gains suggest that investors are still treading carefully, perhaps waiting for clearer signals from global economic trends before fully embracing optimism. This cautious approach reflects the nuanced dynamics at play in the financial landscape, where even positive developments are met with measured responses. Let's break down what's happening in China. First off, there's some good news. During the holiday season, consumers in China have been spending quite a bit, which is a positive sign for the economy. However, there's also some not so great news to consider. China's economy is still encountering challenges, such as sluggish business activity and pressures that could lead to deflation, where prices for goods and services keep dropping. Despite the encouraging signs of strong consumer spending, the ongoing struggles in China's economy underscore the complex issues it's dealing with. While individuals are opening their wallets during the holidays, businesses are facing difficulties, and there's a risk of prices continuing to fall. These contrasting factors highlight the need for careful monitoring and strategic planning to ensure stability and growth in China's economic landscape. Now, let's talk about what's coming up next for China. Everyone is paying close attention to the People's Bank of China as investors eagerly await its decision on the benchmark loan prime rate. Will the rate remain unchanged at its historically low levels? Or could there be an unexpected move? It's a waiting game, and only time will reveal the outcome of this decision. The benchmark loan prime rate set by the People's Bank of China plays a crucial role in influencing borrowing costs for businesses and individuals across the country. Any changes to this rate can have significant implications for economic activities and market sentiments. As investors hold their breath in anticipation, the decision made by the central bank will undoubtedly have ripple effects on China's financial landscape and may even resonate beyond its borders. Now, let's explore what's been happening in the rest of Asia lately. In Japan, the Nikkei 225 index saw a minor decline due to investors selling off stocks to lock in profits. However, in South Korea, the KOSPI index edged upwards, driven by impressive performances from companies involved in manufacturing semiconductor chips, which are integral components in various electronic devices. Despite these positive movements, challenges arose for certain companies. For instance, Nintendo, a major player in the video game industry, faced setbacks following news of a delay in launching its highly anticipated successor to the popular gaming console. Turning our attention to Australia, the ASX 200 index showed little change, indicating a relatively stable market environment. This muted performance reflects the cautious stance adopted by investors amidst the uncertain economic conditions prevailing across much of Asia. Despite fluctuations in individual markets, the broader picture suggests a mixed landscape, with some areas experiencing slight declines while others manage to eke out modest gains. As investors continue to navigate through these varying dynamics, staying informed about the factors influencing market movements remains crucial for making sound investment decisions. These updates serve as a valuable reminder of the dynamic nature of investing and the ever-changing landscape of financial markets. Amidst the fluctuations and uncertainties, there are always opportunities waiting to be seized by those who are diligent and attentive to market trends. It's a testament to the fact that successful investing requires more than just luck. It demands a keen understanding of market dynamics and the ability to adapt to changing conditions. In times of volatility and uncertainty, investors must remain vigilant and proactive in their approach. While it's natural to feel apprehensive during periods of market turbulence, it's important to remember that volatility also brings with it the potential for significant gains. By staying informed about market trends and economic indicators, investors can position themselves to take advantage of emerging opportunities and mitigate potential risks. Furthermore, these market updates underscore the importance of having a well-diversified investment portfolio. Diversification is key to managing risk and maximizing returns, especially in volatile market environments. By spreading investments across different asset classes and geographic regions, investors can reduce their exposure to any single risk factor and increase the likelihood of achieving long-term financial goals. So, while uncertainties may persist, savvy investors can navigate the ever-changing landscape of investing with confidence and resilience. Thanks for tuning in to Stock Whispers. If you enjoyed this video, give us a thumbs up, subscribe, and hit that notification bell so you never miss out on our expert investing advice. Until next time, keep listening to those whispers and let them guide you to your next big win. See you soon!